All right, so we're going to do a first-time homebuyer masterclass. So everything you need to know before buying your first home, from saving to pre-approval to ring offers, closing, and getting the keys. I've done a few of these, just so you know, for various states, including down payment assistance and things. If you'd like to take a look at those, please do check that out. There's a whole playlist for them. So, all right, for sure, anything you want to talk about? Where do you even start? It's a question we get often. So here are some of those questions we get. How much can you afford? What credit score do you need? Which loan should I use? Should you use assistance or down payment assistance programs? How much money do you need? Pay off debt? Do you need 20% down? When do you call a realtor? Process becomes much easier when you understand this roadmap, right? So today's agenda is going to talk about getting ready, financing the purchase, finding and buying. So finding that property, right? Making that offer, working through that finish line after closing and developing wealth. We want to guide you in that, right? So essentially going to give you some good information. So the one thing I want to start with is really the truth here. You don't need to know everything before you start. So you don't need perfect credit, 20% down, zero debt, six-figure income to know every single mortgage term. What you do need is a realistic budget, a review of your finances, a plan, and the right team. So the first step isn't shopping for homes. It's understanding your numbers, right? That's one thing we do with our clients. Just as a footnote, we like to talk about how high you're pre-approved for, high five, good to know. More importantly, what do you spend monthly? What's going to fit your budget? What's going to bless you? I'm going to go over those things. It's important. So getting ready, should you buy a home? Buying isn't automatically better than renting. That's a big misconception we have. Buyer makes sense when your income's stable, expect to stay in the area, you have adequate cash after closing, monthly payments comfortable, and you're prepared for maintenance and things that can come up with the property. Renting make more sense when you expect to move soon. Your income is uncertain. You have a little emergency savings, you need flexibility. Buying costs are much more than renting. So the goal is to not buy a home at any cost. The goal is to make a smart housing decision. So, big question here. How long should you plan to stay? Your time horizon matters. Buying and selling real estate involves these transaction costs and this when you purchase a property, right? So, closing costs includes escrow, title, taxes, insurance premiums, inspections, appraisal, right? Moving expenses, repairs to the property after you buy, there are repairs, right? If you're selling property, of course, commissions when selling, market fluctuations. So because of these costs, buying generally makes more sense when you expect to own the property for several years. The shorter your expected ownership period, the more carefully you should compare renting versus buying. So here's an anatomy of a monthly payment. One big point here, don't begin with the purchase price, begin with the payment. So principal, interest, property taxes, insurance, mortgage insurance. These things make the payment. Principal, let's say it's a 30-year fix. That's principal contributed towards that 30-year fix for the course loan. Interest is the interest over that term. Property taxes, depending on what state you're in, are calculated by the property or by in California, for example, we have Proposition 13. It's 1/4 of the purchase price. Homeowners insurance, if you put less than 20% down, you have mortgage insurance. And then if there's an HOA, like a condo, right? Or some of that sort. So know these four numbers. Your monthly take home income. What actually reaches your bank account? That's your net. Two, obligations, debt payments like auto loans, credit cards, lines of credit, if you have one, right? There's recurring expenses, including grocery. People don't think about this. Grocery. You have perhaps gas, right? Electricity, cable, cell phone, available cash. How much can you use without draining reserves? And then here's a comfortable housing payment. So your mortgage should fit your life. Your life should not revolve around your mortgage. Four parts of mortgage qualification is credit, income, assets, and property. So you qualify, the property qualifies, both matter. Right. So your credit score matters, but it isn't everything. Credit can affect loan eligibility, interest rate, mortgage insurance, down payment requirements, loan program options. Potential credit issues could be late payments, collections, higher credit card balance, limited credit history, bankruptcy, foreclosure, short sale. So don't assume your credit prevents you from buying. Have it reviewed. Should you pay off debt before buying? Not necessarily. Paying off debt may improve debt income ratios, so the amount of money that you earn versus what you spend, increase your buying power, improve cash flow, potentially improve your credit. But using cash to pay debt may reduce your down payment, reduce emergency reserves, increase cash to close pressure, eliminate repair, moving funds. So every dollar has a job. Compare the impact on the entire transaction. So should you pay down that credit card? Let's talk about that. We're gonna unpack that a little bit. The fastest way to change a mortgage profile is simply this, but you have to do it right. So revolving balance is high. Question is, will it drop utilization meaningfully? If you pay it down, improves credit score and pricing, hold cash, minimal score benefit. So build a strategy, don't guess. Closing accounts may not help. So don't just close credit cards without talking to someone and reviewing it. Rapid site consultation. Look at the caption underneath this. We'd love to get a call with you to discuss this. Moving balances without a strategy may not help. Draining savings may create another problem. Down payment, closing costs, right? So build a mortgage specific credit strategy before making major changes. We'd love to have a consultation with you. We'll show you how at the end of this presentation. It's a QR code, but this is what we'd like to spend some time on and go over with you. So income, do you need at least 2 years at the same job? No. Is the answer there? This is one of the most common mortgage myths, by the way. Lenders generally evaluate employment history, likelihood of continuance, changes in compensation, income stability, gaps in employment, career changes. Yes, but a new job does not automatically prevent you from qualifying. The complete employment story matters. Let's say you're in nursing school and you become a nurse. You spent 2 years in nursing school. We can use school transcripts for job history. Let's say, same thing, nurse. Let's say you're working at one hospital. Now you're working for a private practice or another hospital. Well, that's a job change, same profession. Get the offer letter, you want the pay stub before closing. It's usually how that works, preferably before you even get an escrow. So salary is only the beginning. Salary, hourly, overtime, bonuses, commissions, right? So if you have these sorts of things that help self-employment, if you have rental income, military income, retirement, these are all forms of income. So not all income is calculated the same way. The income you earn and the income a lender can use may be different. Owning a business doesn't prevent you from buying. Keep this in mind. Traditional financing may review personal and business tax returns, K1s, profit and loss statements, balance sheets, right? Alternative programs could just look at the bank statements. How much money is coming in through the business? What's the net expense ratio there? Profit and loss loans, asset-based qualification. There's a lot of other non-QM loan programs. So don't assume tax write-offs automatically prevent homeownership if you're self-employed. So how much money do you need? Cash close has multiple parts, and down payment's only one. Down payment, yes, we mentioned closing costs. That's escrow, title, right? Those hard cost appraisal, credit check, inspections, right? That's the hard closing costs. Prepaids could be the interest through the remainder of the month, property taxes, insurance premiums, right? And then you have inspections, appraisal, right? Moving in reserve. So the down payment is only one part of the cash needed to buy. Plan for the whole bar, not just the biggest slice. The 20% down myth. You may not need 20% down. Conventional is as low as 3%. FHA 3.5%. VA, if you qualify, is 0%. USDA, if in a rural area and you qualify, is 0%. Still have closing costs, but there may be assistance programs that offer down payment and or closing cost help. So the question isn't how much can I put down? It is how much should I put down, right? So 3% versus 5, 10, 20. More down is automatically better, right? Why? Well, you want to complete and compare a financial strategy, not just the down payment. So you do want to look at, yes, if you keep more cash, great, but what do those payments look like, right? So gift funds, your payment doesn't always have to come from you. So you could get a gift from a family member, right? VA doesn't require to be a family member. Down payment, closing costs, reserves in certain situations are needed. What we need to really look at is documentation, transfer funds, and source those funds. So just a little footnote there. Don't move large amounts of money around without speaking to your lender, your loan officer first. So down payment assistance. There are a ton of programs. Here in California, we got so many. I counted up towards like 70 plus the other day that I'm aware of, and there's a lot more that I'm unaware of, candidly. But Cali Chife, my home, Dreamfill, the Golden State Finance Authority are kind of the biggest ones, but there are city and county programs, employer assistance programs. Kaiser has a great program for physicians. We work with a few of those year over year. Community programs and grants. So not every program is free money. So you want to compare interest rates, monthly payments, repayment requirements, shared appreciation, income limits, purchase price limits. So what's a pre-qualification? It's a starting point. Information is provided by the buyer, estimated income, estimate assets, estimate credit, limited documentation. Pre-qualification is not the strongest approval you have. Okay. What's a pre-approval? A stronger review. That's where things are reviewed like credit. We review income documentation, asset documentation, employment, debt obligations. Then, of course, we run through an automated underwriting system in most cases for eligibility. So the quality of the pre-approval depends on the quality of the review. This is what we prefer. Full underwriting. To be determined, TBD. Property hasn't been selected, but the borrower is already under it. It will help you be aggressive in a market where there's competitive offers and in other markets where maybe not as aggressive, but the seller is willing to work someone who's fully approved and can close quickly. You may get incentives like closing costs, reduction in home price, right? So why it matters, stronger offer, short financing, contingency, greater certainty, faster closing, less risk. Choosing your loan program. So there's a few here, right? Mention this. Conventional, 3% down, flexible, wide property types. FHA, 3.5% down, flexible credit, higher DTI allowed. VA, eligible military, no monthly MI. Interest rates are incredibly attractive. There's USDA eligible rural suburban areas is 0% down. Non-QM bank statement loans. So those alternative documentation loans, they are a little bit different there, right? So conventional loans, let's talk about them. As low as 3% down, fixed adjustable rates, primary, second homes, investment properties, single family home condos, up to 4 units. There are mortgage insurance options available if you put less than 20% down. So it can be incredibly flexible. Loan limits do apply. FHA loans, 3.5% down. Flexible credit requirements, higher debt ratios may be possible, gift funds and seller contributions, and there are renovation loans. The challenges are upfront and monthly mortgage insurance, no matter what the down payment looks like. Property condition requirements. There are county loan limits and condo eligibility. So FHA is not only for first-time homebuyers. I want people to understand that, but it's not just first-time homebuyers. VA USDA potentially 0% down. VA, we do quite a few of these. Eligible veterans and service members, we have a full presentation on these and a masterclass. So check that out if you haven't already. But 0% down, no monthly mortgage insurance, reusable benefit, and competitive financing. USDA, eligible properties in designated areas, income limits can apply, potentially 0% down. Primary residences only, and then there are property eligibility requirements. So eligibility matters more than first-time homebuyer status in these cases. So what's mortgage insurance? Conventional mortgage insurance is going to vary by borrowing transaction and may be removed when requirements met, usually 20% equity. FHA, no matter what, it's going to be there. VA, there is no monthly mortgage insurance. Pay mortgage insurance may be way better than waiting 20 years or 10 years or 5 years, whatever it might be, to save 20%. So run the numbers. There's no single mortgage rate. So your rate can depend on credit score, down payment, loan program, loan amount, property type, occupancy points if you're buying them down, or lock period. So rates change daily, sometimes multiple times in one day. The rate you see online may have little to do with the rate that's available to your transaction. Candidly, that's known. Why are those rates there online? So you look them up, you click the button, and you'll get 50 people calling you in a single day. Seriously, they sell those leads. Rate versus APR, it's not the same thing. So interest rate is usually calculate the principal and interest payments, and APR attempts to reflect the cost of borrowing by incorporating certain loan costs. So APR could help compare rates, but different loan structures can make different comparisons. Difficult time horizon, upfront, and cost matter. Credits matter. Discount points, the break-even question. Points cost money today. Save money month to month. When do savings catch up? Here's a little graph, just to give an idea on this scenario, right? Where you pay points and it takes 40 months to recover. So it's a straight, but don't pay points without calculating your own break-even point as the cost here. If you spend $3,000 to, as you did in this graph, where this individual did, 40 months to recover that savings, that's not worth it, right? Seller credits can be negotiated, not just the sales price. So seller credit may sometimes create more immediate financial benefit than the same amount taken off the price. This could be because of closing costs, temporary buy downs, permanent rate buy downs. So the best offer isn't always the lowest price. Best negotiation isn't always about the price. Let's talk about temporary buy downs. Again, I have a presentation on this as well, but this is loans where you have a 3-2-1 buy down, 2-1 buy down, 1-0 buy down. Those are You have a rate, let's say 7%, just a year's a round number. If it's a 3-2-1 buy down, year one's 4%, year two's 5%, year three is 6%, year four and thereof is 7. 2-1 buy down, 5, 6, 7. 1-0 buy down, 6, 7. Does that make sense? So basically, it gets the payment lower that first year. The seller can pay for it, buyer can pay for it, the lender can offer a credit to pay for that as well. So this is your team. You should not do this alone. You want a solid loan agent, a solid real estate agent, solid insurance agent, home inspector, escrow officer, mediate the transaction, right? Title. In certain states, we have attorneys, but a certain solid CPA financial advisors also need to be. We have referrals for these members, candidly. We could help with that. But a great team solves problems before they become emergencies. It's the biggest financial purchase you ever make. I want to make sure you're good, right? It's important. So how to choose a real estate agent? Ask better questions. Do you work in the areas I want to buy? How do you help determine offer strategy? How quickly can you show properties? How many buyers have you represented recently? How do you evaluate comparable sales? How do you work with my lender? The agent matters. How do you choose a lender? Can you fully underwrite me before I shop? Do you call the listing agents when I make the offer? How quickly can you issue updated pre-approved letters? How quickly can you close? Are you a direct lender and a broker? Are you just a lender? Are you a bank? Are you a broker? How are you set up? Who processes and underwrites my loan? So remember, the lowest advertised rate is not enough. Execution matters here. Start shopping. Now the fun part begins, right? When you're pre-approved, you're ready to go. You know your comfortable payment. You know your maximum payment. You have a cash close strategy. You have target areas, property priorities, your commute tolerance, understanding insurance and taxes. So shop with a strategy, not just a pre-approved letter. Be mindful here. Don't fall in love with the house yet. Evaluate the property before writing an offer. Comparable sales, taxes, location, resale, property condition, HOA deals, repair, needed insurance. There are assessments. They can happen with HOAs especially. So the house has to fit your finances in your life. There's an anatomy of an offer. Price is only one part. Purchase offer 700K. In that, you have earnest money deposit, which is usually 2 to 3% of the sales price, due within 48 hours of your offer being accepted. You have a loan contingency unless you're fully underwritten with us, right? Usually, in most cases, 10 days or more. Appraisal contingency, usually 7 days on average, is what we're finding in California. Inspection contingency, closing timeline. If there's any seller credits or rent back, let's say the seller wants to stay there, they're going to rent it back to you. That will be negotiated. Appraisal gap strategy. In the event that the appraisal does not appraise, that's there. So the price is the headline. These terms are the fine print that wins or loses a deal. The strongest offer is not always the highest offer. How to compete without being reckless. Strong offers are built before offer day. Full underwrite. Verified funds. Update pre-approved letter. Lender to call the listing agent. That's so important. I tell my guys all the time, and I do it. Call listing agent as soon as the offer is made. Shorter financing contingency or no financing contingency if you're fully underwritten. Fast appraisal ordering. Flexible closing time. Strategic seller credits, understanding appraisal risk, clear communication. Communication is everything. So winning the house is important. Buying the right house in terms you understand is even more important. So your offer is accepted. Now what? Escrow begins. The timeline starts to be contract goes to lender, disclosures and the earnest money is then made, inspection, insurance, appraisals ordered, processing and underwriting, final approval, see closing disclosure goes out, and the fund record. In our world with our team, each one of these about 2 days max. We close most of our transactions in 15 days. So this kind of gives a breakdown of that, right? So the home inspection, let's talk about this. Inspection evaluates the property condition for roof, electrical, heating, cooling, foundation, plumbing, drains, and safety. Appraisal, on the other hand, market value, comparable sales, marketability, minimum property standards. Don't confuse the two. They are different, right? Essentially, the appraiser looks at it, tells you how pretty it is, if it's worth what it is. If there's anything that stands out, they'll call it out, yes. Inspection, nuts and bolts. It's nuts and bolts. You're going to learn more about that there. All right, so this property, support the price. That's what the appraiser wants to value. Property characteristics, condition, comparable sales, marketability. So possible outcomes, value supports the price, values below the price, additional review needed, If it exceeds the price, repairs are required. That's what the appraiser would do. Now, if it's not appraising for what you're offering, that'll work, right? So you can do that. So a low appraisal does not automatically mean the transaction's over. So what happens in underwriting? The loan's verified, right? So credit, income, employment, assets, debt obligations, loan program, property appraisal, title, insurance, source of funds, occupancy. We find all that out, right? Then the may issue conditions are normal. The goal is to satisfy them quickly and accurately. So don't blow up your mortgage. These are big things to remember. Don't do these things. Open new credit accounts, co-sign for somebody, deposit unexplained cash, finance furniture, change jobs without discussing it, miss payments, buy a car, move large sums without documentation, or spend your cash to close. Your finances may be reviewed again before closing. We'll make sure everything's there. It's important to know these things. Clear to close. What does CTC mean? Clear to close generally means that the loan satisfied the underwriting requirements necessary to move toward closing. This could be to any subject closing requirements that may happen. They run review documentation after they're signed before they fund in a lot of states. Some don't require funding conditions, candidly. They're called wet fund states. So the wire goes with loan docs and then they're signed off. But CTC is a major milestone. But you don't own the home until the transaction completed and recorded. So closing disclosure. This is a document you'll get 3 days before. You want to make sure you look at it all. Loan amount, interest rate, what the monthly payments are, closing costs, cash close terms, escrow account. Ask questions before signing day. Make sure you go over those. That's huge. So signing, funding, recording keys. So the keys then come after record. Congratulations, you bought your first home. So your first year as a homeowner, the work isn't over. You want to build and rebuild emergency reserves just in case. Watch for property tax notices, budget for maintenance, avoid unnecessary equity borrowing, understand your mortgage payment, review insurance annually. You always want to do that. Make sure you're properly insured. Keep important closing documents. Monitor interest rates. Homeownership is a long-term financial responsibility. If you work with our team, we like to follow up with you. That's our job. Want to make sure you're golden and you're good. We're going to go over that with you in detail just to make sure you're okay there, right? So we continue to follow up. So should you finance later? Maybe lower interest rate, lower monthly payment, remove mortgage insurance, shorten the loan term. These are all reasons. Refinancing has costs, but don't refinance because someone calls you. Refinance when the math improves your financial situation. That's ultimately what you want to do. So think beyond closing day. Buy a first home, build equity, increase credit. Refinance when beneficial, convert that property to a rental. Then buy a move-up property, build long-term wealth. This is what I did. I have quite a few properties myself, and we built a real estate portfolio. The first transaction can create options for the next 10 years. Remember that. So, case study. Your client that before they were shopping, we got them fully underwritten. They read a non-consent offer, 10-day close. Offer was then accepted. Property review came in within 3 days with that appraisal. 3 days thereafter, we're clear close. Docs went to escrow. It helped, right? So before shopping, income reviewed, verified, assets verified, credit reviewed, fully underwritten, made a stronger offer, shorter contingency, faster closing, greater certainty, and the work can be done before the offer is made. And it does, in this case, it did change the transaction. Price reduction versus finance strategy. Another kind of thing to think about here, right? So that saved this buyer monthly payment. Why? Because rather than that, they actually got a credit towards closing costs and they looked in a better situation. So the 10 things I would tell you, these are some mistakes. Be aware of them. Watch out for these things. Shopping before understanding the monthly budget. Waiting till you have 20% down. Assuming your credit's not good enough. Paying off debt without a mortgage strategy. Using all your savings to buy. Don't do that one. Choosing a lender based on only rate. Getting only a basic pre-qualification. Ignoring insurance, taxes, and HOA costs. Making other financial changes during escrow. Think about only buying, not owning. Preparation creates options. Here's a playbook. 12 things to do before writing an offer. Build your comfortable monthly budget. Review your credit. Verify your qualifying income. Review available cash and reserves, compare loan programs, compare down payment strategies, review assistance programs, get fully underwritten when possible, choose the right realtor, understand your target market, build your strategy, and know your 3 to 5 housing plan, right? 3 to 5 year housing plan. Don't just get pre-approved, be prepared. So if you want to connect with me, there's the QR code. I would love to help. Get a call with you. It's free. Costs nothing. A couple of minutes every time. We can go over things. If you want to apply, there's a link to do so as well. But I mean, I would love to go over all this and just unpack this so you'd understand home ownership. That's why we're here, right? So any questions come up, shoot me a message, drop a comment below. Thank you for watching this.